So today, everybody, we're going to do a video on first-time homebuyers because I had a dear friend call me and she was like, yeah, I want to buy a house, but you have no videos on first-time home buying.
Oh, no,
Yeah. Yeah. So, okay, this video is for first-time homebuyers. And then I have my dear friend and referral partner because he's great at what he does, Steve Lee. Tell me a little bit about yourself, Steve, and how long you've been in business and stuff. Just so they get qualifications, you know what I mean?
My name is Steve Lee. I work with Pinnacle Lending Group. I've been in the business for over 2 decades, all here in Vegas, and I've been in Vegas for over 40 years. So
yeah.
This is my home, this is my town, this is my community.
Yeah.
So,
and you know it in and out. You are a big part of the community. Every event I go to, you're there, and I appreciate that because I know somebody there.
No, I try. You know, at the end of the day, we have to have a full circle. You know, it's just not working. It's just getting out in the community, and you know, I think each person, one person makes a difference. You know.
Yeah.
We feel like it's just me, but it's not just you.
Yeah.
If I want that way, nothing ever get done. So, you know, each person makes a difference, and next, you know, you have so many people, everyone's being helped and taken care of. So at the end of the day, yeah, I'm here just to help the community, help people that can become first-time home buyers, build their real estate portfolios. That's one of the best ways to build wealth.
Yeah, 100%.
You know? So that's just getting good guidance from an amazing realtor like you, that seasoned, that knows the business. Yeah. And I take care of the money piece. So, but it's someone that takes you to the right homes.
Yeah, and the money piece is so important. But first-time home buyers, my friend who I'm actually making this video for, so Melissa, this is for you. Actually, she asked me, like, you know, I want to buy next year. I'm a first-time home buyer. When should I get started? And my advice to her and to anybody out there is get started right away. Don't wait. She was like, I'm not ready to buy till next year. I'm like, get started right now, because if you don't have your ducks in order, you know, it's going to take you another 6 months to get in the process in place. Yeah,
6 months or
at least, right?
Or it could cost you money.
Or
you know, so I think one of the great things is if you start 6 months, a year out, is you know, you want to get yourself in the best position. One is credit, you know, because credit dictates interest rate. Yeah. And also, if you're not putting 20% down and you're going conventional, then it also dictates what you're going to pay for monthly mortgage insurance, and private mortgage insurance. Yeah, so which is super expensive. It's super expensive.
We'll get in all that. I made him go get his computer because we're going to run some numbers on this. But I think the first and most important step is determining, like, I want to become a homeowner, right? That's the first, to get that mindset. I'm tired of paying rent. I'm tired of every month my rent goes up. You know, if you live in a house, I've ran into this many times. Sometimes the person you're renting from tries to sell a house out from underneath you. That happens a lot. You're moving. And it's just a place, you know, you get in that mindset. You want a place called home. You know, you want to start building that portfolio and, you know, start getting that instant equity. So the first and most important thing is mindset. And once you get that mindset down, you're like, okay, I want to buy. I think the next step is to reach out to a professional, someone you could trust, do your research, watch these videos, call around. Please do not go on Zillow, because you never know who you're going to get on Zillow. You can
Redfin.
Yeah, or Redfin, any of that, because you can get an agent that's been doing it for years, or you can get a brand new agent, and that can cost you lots of money and seriously hurt yourself.
Yeah, absolutely.
Yeah.
And to me, you know, what would be my biggest recommendation for shopping for a lender? I think first thing is communication.
Yeah, 100%.
You know, because especially if it's your first time, you want someone that communicates, that explains the process, that answers your question, that doesn't make you feel bad because you're asking a question. You know, I mean, especially first time home buyer, or regardless, I mean, it's not, finance isn't your field. It's not your field.
No, it's not my field. That's why I brought you here. Yeah,
so if a lender makes you feel bad about asking basic questions, then that's
probably
probably not the right person, fit. You know, because lenders should want to show you everything that you want to see and more. Yeah, and that's why I use Steve.
So once you find a great real estate agent, he's going to have their preferred lenders lined up. Steve is one of my preferred because he answers everybody's question with sincerity and honesty, and there's no such thing as a stupid question when it comes to finance, because they don't teach you this in school, unfortunately, which they should, but they do not, and that's a big step. So We're here with Steve. I'm going to have him run some numbers, but let's go over this. So once you get a hold of your real estate agent, and I usually give them, 3 different lenders that I work with so they can shop around, because Steve's not mad at that at all. He respects that. The power of 3 is incredible. So go over the home loan process once I send somebody over to you. We have this up on the big board so they can see.
So basically, the first step is your application. So what the application is going to do is it's going to give your information on where you've lived for the last couple of years, plus also your employment information. And that's important because we have to make sure we could verify 2 years work history.
Yeah.
So one thing is, I think in the past, you have to work in the same job for 2 years to buy a house, and that's what some people think.
Yeah.
But it doesn't have to be the same job for the last 2 years. It doesn't even necessarily have to be in the same field. As long as it's full time,
Okay.
you're guaranteed either 40 hours a week at, $30 an hour, and you show that on pay stub consistently, you're working 40 hours every week.
Okay.
Then that shows that you're working full time. And as long as the employer verifies you're full time, then we can use that income. Salary, then salary is even better. You could work 5 hours a week or 100 hours a week. You're still gonna get the same money. So
Yeah.
one is to make sure we know what income you're making and it's consistent. And then where you live for the last couple of years. And then the other piece is your credit. So credit is also very important. That dictates risk for the lender. The lower the credit score, the more they feel like there's more risk. So with risk, that means sometimes you're gonna get higher interest rate, and also if you're not putting 20% down, you're gonna pay higher mortgage insurance.
Yeah. PMI, and which we'll get into that soon.
So that's why we recommend, if you're just thinking about it, but maybe you're not ready right now, you know what? Let us at least kind of evaluate you, see where you are right now, and then you could at least put some, steps in process.
Yeah.
To be ready and so you could get the best terms and have the best options for you. So that's where the application starts, and then also we talked about credit inquiry.
Yeah.
So one is you don't want to have your credit pulled any more than you need to.
Because it dings it, right?
Yep. It dings your credit score, and people do ask, well, how much is that going to affect my credit score? Well, it's all algorithms, so there isn't like if someone pulled your credit once, it's going to lower your credit by 3 points or 5 points. It's all based on your individual credit profile and how it looks like. So it could affect your credit a few points. It could affect your credit 10 plus points. Mm-hmm. So it's just depending on individual. But if you have especially if you're not going to be buying something for 3 months plus, then you want to ask lender if they're able to do what it's called soft credit pull, which at my company we do offer that. So then it's not a hard inquiry, so it's not going to affect your credit score at all.
Yeah.
So, if you're just thinking about it, like I said, let's do a soft credit pull. Usually we pull it from one bureau, so it gives us a pretty good idea, and we'll go over it. And if you think something's missing because one of the other bureaus that we're not pulling from may not show up, but most credit is going to show up on
all of them.
On all of it.
Yeah.
So as long as you pull one, we're going to get a pretty good idea where you're at, and also help you strategize if your credit's not, 700 plus. Then let's see what's on there that's affecting your credit and get you in the best position.
Okay.
So we talked about credit and documentation.
That's a big one, right? Because sometimes it takes people a long while to get that documentation. It's a pain sometimes to get it, right?
Yep. So if you're preparing, make a little folder, for my future home or something. Just slip your pay stubs in there. Your W-2s. Usually we need last 2 years W-2s. If you're hourly or salary employee, most cases we don't need your tax returns. So people stress sometimes like, I don't know where my tax returns are. So if you're doing a standard like FHA, VA conventional loan, most time we just need your W-2s for the last 2 years, and then your most recent monthly pay stubs. That's also that's like 4 sheets of paper.
Yeah.
So it's not a lot. If you're self-employed or 1099, or you have, if it's not your first home, maybe you have some other investment properties, then we probably need you to look at your tax returns. So that's a whole nother thing. About,
and it gets deeper. So
we could have just said another day. But, your basic hourly employee salary, all we need is your W-2s for the last 2 years.
Okay.
And most time, and if you didn't save it, like I said, put a folder together, stick it in there. Most employers have an online system, so you could just pull that stuff off.
Yeah.
So if you could do that, then you don't even have to build a folder. As long as you know you could access it. So one thing is, if you don't know, check with the HR payrolls. Like, if if I need access to my W-2s or pay stubs, is that something I could easily access?
And usually employers have that online.
Yeah,
easy
especially
access.
like the big companies. There's an online system called Work Number, and a lot of times it'll pull up last 2 years' earnings, and what you made. So there's different ways to verify it. So, it's not bad as it seems. I think some of the stories old days was, it's like pulling teeth. People want your blood type.
Yeah,
blah,
well,
blah,
it
blah,
depends.
all this stuff.
It depends on the lender and how much you got going on with your business
yeah.
as 1099.
Yeah.
That's another story. Though. Okay, so after we collect all the documentation, processing.
So basically, once I get all those documents, then what I do is run it through a system. It's an automated underwriting system. Make sure everything's okay. It's going to read your credit, your payment history, everything else that's on your credit, the income that we put in, and basically it'll say loans approved, as long as we get everything that's on that sheet. When the system spits out the approval, it is that we want this, this, and this. Okay. So it's a very streamlined system, and that's where the lender kind of, once they do all that and they get the approval and they have your bank statements, your ID, W-2s, pay stubs, then I'll say you're pre-approved.
Okay.
This is roughly what your payment's going to look like, and this is the interest rate that I calculate your payment. But interest rates do fluctuate. So one is when the lender tells you you're pre-approved at 7%, that doesn't mean that's your interest rate. That's how we kind of calculate it, at least get an idea if you're going to qualify or not.
Yeah.
And hopefully by the time you find a house,
it's lower.
Rate's lower, right?
Well,
and that's our ultimate
that's
goal,
the goal,
to make you happy. So, and one is once you do get that pre-approval letter, basically what the lender's doing, we pre-approved you on a snapshot of the credit that we pulled, what you gave us.
Yeah.
So it's not, sometimes people think like, okay, I'm pre-approved, so now I could do whatever.
Yeah.
And maybe they do something they're not supposed to. One is, once you're pre-approved, you could make your situation better, get a raise, save more money, pay down your credit card. Those are all great, but we're gonna, depending how long it takes, we're gonna may have to update your credit. Credit reports usually last 120 days. So long as I pull your credit today and you close, which means get keys in your hand in the next 120 days, we probably don't need to pull your credit again.
Okay.
But if it takes a bit longer, one is I don't want to keep pulling your credit. So if your credit's going to expire before we actually close, then I'll re-update your credit to make sure it's good until you close, so you don't have any issues during the process where, okay, you're halfway into your transaction on your home purchase and your credit expired, now I've got to re-pull it.
And then you bought a car.
And then something happens and now all of a sudden now you spend money on appraisal, home inspection, and your earnest money deposit. So, but I don't like to pull credit more than twice is my max. Yeah. Hopefully just once. You'll find it within 4 months. Yeah. Especially with a good realtor, you're going to get it within 4 months.
Gotcha.
So you'll be good. And then once you get in contract, once we process the file, which means the processor is going to take all the documentation application that I got from the borrower. Now they're gonna put it together, verify everything, verify employment history from the employer, make sure everything matches paperwork that's provided versus what we verified. And once they get everything together, then they give it to the underwriter. The underwriter is going to review everything, and what they typically give you is approval with conditions. Yeah. Which means I like everything I see, but I got a question on this one thing on your bank statement, or I need this one other documentation. So when you hear it's approved with conditions, that's good news. Yeah. You don't want loans suspended with conditions or loans declined. So when they say it's approved with conditions, that's what you want to hear. And then with those conditions, if a loan officer does a good job, then it shouldn't be that much. Yes. Maybe a few things, 2-3 things. And then you provide those documents, and then we send it back up to the underwriter, and the underwriter reviews those documents. If those are acceptable, what they gave you, approved with conditions. So as long as those conditions are met, now the underwriter is going to say loan is approved. Yep. And once the loan is approved, then we send out what it's called the CD. It's the closing disclosure, which is going to be the next thing to your final numbers before you go to signing a title. And the CD shouldn't be that far off. Yeah. And
you said you guys usually send out an estimate one for me to look at and the buyer to look at, just go over everything to make sure everything's good, right?
Absolutely. So The other piece, before we do all that, once you get in contract and we get the property address and the contract, then what we do is order fees from title, and that'll give you all the different fees that's associated with that property, the lender fees, third party fees. And what we do is we'll give you a estimate. It's called a loan estimate, or LE. And long as the payments are comfortable, what they're showing you, and also the funds to close and all the fees, you sign up on that. That's when we order the appraisal. So that happens in the beginning.
The contract, yeah. Oh, and we'll go over all this stuff.
Yep.
I just wanted to go through that. So this is why I want my clients, first-time home buyers, to start 6 months, a year early, because you don't know what your credit is. You don't know what it needs to be at. You don't know what your financial situation is. You don't know what your purchasing power is when you're going into it. So you might be looking at $500,000 homes, but you're on a $250 budget, but you just don't know it yet. You know what I mean? So that's why you reach out to me first. And when he does that soft check on your credit, he takes a snapshot. And, you know, sometimes right away, a lot of people, first-time buyers, are not ready to purchase because their credit's not lined up. You know, and that's, I think, the most important thing is your credit, right? It's one of the most, if not the most important.
More important things.
Yeah.
That dictates which program you fit into, which programs you have options to go into. So one is, you know, especially buying your first home, you know, first program a lot of people hear about is FHA loan. Yeah. Which is, a lot of people reference it as your first time home buyer loan. But it's not necessarily, you don't have to be a first time home buyer, but FHA is solely for primary residence. But also, if you don't have the best credit, it's the more forgiving loan.
Yeah, yeah.
So your rates aren't skyrocketed. For instance, FHA, as long as we get you approved, we could go down to like 580 credit score. Okay. And the mortgage insurance is calculated, your monthly mortgage insurance is calculated at 0.55. So as long as you qualify, regardless of what your credit score is, 580, 850, you're going to get the same rate, 0.55 for mortgage insurance. Why I'm telling you that is because if you do conventional loan, which is conventionals, if you have good credit, it's a better route to go, even at your first home. But for instance, if you have a 620 credit score, the mortgage insurance that we're talking about as 0.55, that could be like 2.5, so almost like 4 or 5 times. Okay. So if you're talking about your mortgage insurance at FHA is going to cost you $100, right? And you have the 620, if you apply for conventional, you qualify for it, but it may be $400 or $500. Oh yeah. So that's where FHA is. A lot of people know is like first time, maybe get your feet wet. Yeah. Maybe your credit's not the best, but you can still buy a home, build equity in it, and then convert it.
Yeah, and then also you get less down for FHA, correct, than a conventional, or does that really matter?
It's minor. So FHA requires minimum of 3.5% down payment. Conventional loan, if you're a first-time home buyer, and description for a first-time home buyer isn't a first-time home buyer like you never owned a home. First-time home buyer description is if you haven't owned a home or had any interest in a property, then you're still first-time home buyer. So long as you haven't owned a home or had any interest in home in 3 years, you can still apply for conventional. Yeah. And if you have good credit, you could do 3% down on conventional. Okay. And the mortgage insurance is going to be about the same, or possibly even a little bit better. Yeah. And the great thing on the conventional is if you do have a great rate and you never think about refinancing, that mortgage insurance will go away in the future. After that 20% is met, correct? Yep. Yep. After you pay for a couple of years, then either the home appraises, you get appraised and it has 20% equity, or you've just been pounding that balance and got it paid down below 80% what you paid for. It could go away. Where FHA, that's one of the bad side effects of FHA is it doesn't go away. If you put 10% down, after 11 years it goes away. Ooh. But if you don't put 10% down, if you put less than 10, that stays on until you either pay off that mortgage or refinance it into conventional loan. Okay. About 7 years ago or so, before FHA did have the option to have it go away, kind of like conventional. But now FHA, less than 10% down, you're going to stuck with it. That. So and that can be significant, especially if you're on the budget right there. But the reason why I have you call me 6 months, a year out is because we don't want you going into a loan with a bad credit score. So what are some tips? So say somebody called you, they had a 580, they're not going to buy in a year. What would some of the credit score
tips that you would give people? I know some, but
Yeah.
just hear from
Tips
you.
wise, first thing is let's look at your credit cards, your balances. So credit cards, the way credit cards affect your credit score is one is of course payment history, make sure you pay it on time. But what it looks at is your limit versus your balance. It's a ratio. So whenever you go over 50% of your credit limit, it starts dinging your credit.
Okay.
Best balance to keep on a credit card is under 30%.
30%
That's where you
under.
get the maximum benefit and also
Yeah.
get a higher credit score from it. So regardless if your credit limit's 300 or 10,000,
Keep it under.
keep it under 30%.
Yeah.
You don't have to pay it off. And then, installment loans like auto payments, student loans,
Yep.
Fixed payments, those, as long as you pay those on time, that's
They're
all that
good.
matters.
Okay.
But the other part of credit is longevity, how far back your credit goes.
Yeah.
So the only type of credit that gives you that longevity is credit cards. Because credit cards, as long as you keep using it
Yeah.
and you don't close it, you could have a credit for 10, 20 years. And that's what's going to build that longevity.
Man.
Because like installment loans, where you have a structured payment, you paid for 2 years, 1 year.
Yeah.
Once you paid, those close. So once most credit items, once they close, they're not really factored into your credit. So those you don't have a choice. Once you pay off that balance, and they close it, and it's done.
And I heard another trick is to, if you have like 3 credit cards, is to use one for that 30% and then flip flop them. Pay that 30% off, then use another one and keep those other 2 at 0. Is that true, or does that work?
No, I mean, as long as they're all under 30%,
okay.
It's benefit. Don't think it's the payments associated with those payments. Sometimes you may have to pay those off to help you qualify if you're like tight with your income and what you're purchasing. But bottom line, as long as on credit cards, as long as you keep them below 30%, you could have multiple credit cards. But at the end of the day, all you need is 2, maybe 3 at the most. So you don't need a lot of credit. So one is sometimes they think like just open up tons of credit.
No, that's not always the case.
You don't need to do that.
Okay.
Sometimes like, if you miss a payment on one of those,
that'll
affect
ding
your
you.
credit. So I would say 2, 3 credit cards and maybe an auto loan, and that's all you need.
Yeah. And then no credit's worse than bad credit.
Yeah, absolutely.
Right? For this first time home buyers, if you guys don't got any credit, do an installment loan, buy a small car or something, get a couple credit cards.
Yeah, just get a couple of credit cards, because one is, depending on what your income is, what you want to purchase, if you get a car loan, then that payment may end up hurting you in the long run. Credit cards, just get 2, 3 credit cards, keep the balances low, and typically after you make like 4 to 6 payments, that's going to generate credit score.
Yeah.
I mean, I've had clients where they've had credit for 12 months, 16 months, and they have 700 plus credit scores.
Yeah.
So that's an easy fix.
Yeah.
And what we're talking about bad credit, if you have like collections, late payments in the past, charge-offs, now those are going to be a little bit more time intensive, and sometimes maybe it'd be better if you talk to maybe a collection counselor, and that tells you what's the best way to fix that, where it doesn't keep hurting your credit, because sometimes collections will haunt you forever. Yeah, because typical rule is once it goes in collection after 7 to 8 years, it's supposed to come off your credit so it doesn't affect you.
Yeah, but it's not always the case, right?
Yeah. So what happens, this is so unfair, and I don't agree with this. What happens if a collection company in year 6 sells it to another collection company?
And it starts over
Now
again.
it starts all over. And they do that because of that.
Yeah.
Because what they want to do is put pressure on you. So one day maybe, because the collection companies buy that debt for probably 10 cents on the dollar.
Yeah.
So their goal is to get that money from you, lie, cheat, whatever, so you give that payment. But at the end of the day, the only way, if you do pay off a collection, the immediate help is if that gets deleted. So if you pay that collection company and they gave you in writing that once you pay them what's owed,
Satisfaction of,
then they're going to delete it, which means when I pull it next time, it's not going to be on there. So it's like it never happened.
Yeah.
But if they just tell you, well, we'll update it, from balance of 1,000 to that you paid it to pay collection 0. But the way collection affects you is that's what they call a negative trade line. That's on your credit. That shouldn't be on there.
Yeah.
So regardless if you have a balance or not, the biggest weight they put on collection account is the most recent activity date. So it's not when it happened or when it went to collection, but say you had collection from 10 years ago and it didn't really affect you, but now you decided, like, you know what, I'm going to pay that. You know, I owe that money, I'm going to pay that collection. And if they don't delete it and they update it to paid account, now the recent activity is May of 2024 versus May of 2014. So now when we run the credit, it's almost reading it as if you got that collection this month. So now it's going to ultimately drop your credit score.
Yeah. So
So before you get anything with collections, you know, talk to a lender or talk to.
So if you got bad credit, you're looking to buy a house, that's a long conversation. So just reach out, contact details. Give us a call. Give us a call.
So we've got processing. So, you know, up to the documentation, that's where we pre-approve you. And then the processing, underwriting.
Yeah, we'll go on that on my spot.
So, yeah, so that's all kind of, you know, I think in the beginning is listen to what your agent and lender tells you. And it's a snapshot of when they pre-approved you. So make sure, and at the end of the day, if you're not sure about something once you're pre-approved, just call the lender and ask him.
Yeah, because your lender should answer his phone.
Yeah, if not,
call your real estate agent. They should answer your phone. And if they don't answer your phone, just give one of us a call.
It's all about service.
Yeah, 100% in this.
It's all about service and communication, and that goes a long way.
Okay, so 100% financing, 0 down payment, FHA down payment assistance. Okay. So my first-time home buyers, they always ask about this, and sometimes it's good for the first-time home buyer, and sometimes it's just that doesn't make sense, right? Yeah. So let's go over this real quick.
So one is, you know, there's different programs. You know,
100%.
One is there's one provided by the state. It's called Home as Possible, and they give you based on which program and how much you need help. The rates fluctuate, but typically rates on those are, I would say, at least 0.5% to 1.5% higher than the market rate. And also some of them have restrictions on how long you have to keep that loan. So say a year down the road, rates drop 2 points, so you want to refinance.
You can't.
With that, you can, but then now you're gonna have to pay back that money. A portion of that money they helped you for the down payment.
I got you. Okay.
So there's restrictions on what you can or can't do. And then also there's income limits. So a lot of those grant programs provided by the state, you know, and grant programs, they have one is for first-time home buyers. Also they have income limits based on family size. So if you make over a certain amount, then you can't qualify for that program. So, but those are all good programs, but we have one that at our company, it's 100% financing. It's FHA, but it's not a grant. We're basically financing
all of it.
So say you buy a house for $100,000.
Okay.
If you do FHA, requires 3.5% down payment, which is $3,500. So we'll finance 96.5 on your first mortgage,
and then your second mortgage
we'll finance
down
payment on your second. So there's no grant, there's no money someone's helping. Basically, we're just financing the whole thing. So the great thing is, since it's not really a first-time homebuyer program, you don't even have to be a first-time homebuyer.
Okay.
As long as you qualify, you can apply for this program. So it opens up for more people than the other programs. And the thing is, 6 months on the road, you know, the house goes up in value. You could refinance.
Okay.
Or, you know, what I suggest if you do get into this program is focus on paying off that second, you know, the down payment portion. Focus on paying that off. Get rid of that. And then next thing you focus on paying down that first mortgage.
Yeah.
So it's a good program, and it doesn't get you stuck in that loan or in that house.
Yeah.
So you could do whatever down the road, just like any other loan. You could refinance, you know, sell it, pay it off.
Okay. And then if you want more like requirements on this, you know, you want more details on this, just call me, get a hold of me. And this is why we do this, because this is why this financing is so long. And I brought Steve in because this is pretty much the biggest part of the first-time home buyer. The biggest roadblock is financing.
Yeah, financing. Yeah, and then down payment sometimes.
Yeah,
you know, right now, especially with everything so expensive, it's hard to save money. You know, you're just trying to survive.
Yeah,
so,
100%.
So right now, I mean, I think this is a good fix. But like I said, there's other programs. It's a lender's job to get a full picture of you, your income, your debt, your credit, and give you some options or find the best fit for you for right now.
Yeah, so this says 2% greater than the first lien, so that's going to have a high interest rate. It amortizes over 10 years, so pretty much after 10 years it'll be gone, right?
Yeah, if you just make the minimum payment.
Yeah.
But
620 minimum monthly payment, no income limits. That's pretty cool. But all right, multi-family home buyer. This is great for people, especially wanting to get investment and start building a portfolio. I have a friend that first house he bought was a duplex. He's in California. They're all over the place, which, you know, he's Airbnb-ing that out, and then he pays a little bit less for his home, and you know, he's building equity and putting money in his bank account. So tell us about this Fannie Mae minimum 2 to 4 unit properties after 5%.
So when you buy multiple unit property for primary, that means you're going to live in one of the units.
Yeah.
So FHA used to be a good go-to program because as long as you live in one, you could do low as 3.5%. But probably 3 to 4 years ago, FHA added another hurdle, which is the 3 units that are being rented out has to support that mortgage payment that you're getting. So even though you qualify with income to support it, if the 3 units can't support that payment, you can't use FHA, even though your income qualifies.
Okay.
So that's that right now, especially with the price of the homes and rental, it's a lot of times it doesn't work for FHA.
Okay.
So
So what you were saying? So those, so you buy a four unit. So you buy a fourplex, right?
Yeah.
You live in one, but if those other 3 units don't cover that mortgage, they're not going to give you the loan.
Yeah, even though your actual income supports it.
Okay.
So there's 2 qualifications: the property has to support itself,
Uh-huh.
plus your income has to support it.
Yeah.
Before, that first piece wasn't there, so it was a great program. You know, your first home you're buying, you're moving into 1 units. Now you got 3 rental properties, and down the road you could move out and rent the 4th one, buy a house, whatever.
Yeah.
So it was a great way to break in and buy a multi-unit property with 2.5% down.
Yeah.
Which is amazing.
Yeah, but now it's because costs of units are so much. Those 3 by themselves are not going to cover that mortgage.
Up with the cost.
Yeah.
But great thing with Fannie conventional loan, before, if you want to, even if you're going to live in one and you're buying a multi-unit property, you have to put down 25%, even though you're going to live in one.
Okay.
So that's hard for
it's a lot of money. It's a big chunk of change.
25%.
Yeah.
But last year, Fannie made a change. As long as you're going to live in one and your income qualifies, then you could buy with 5% down. So it's 1.5% more than FHA, but you're buying basically 4 properties with 5% down.
That's pretty cool.
And they don't have that addition that FHA added. So
to where you need
3 units doesn't have to support it. As long as your income qualifies, then you're good. So this is a good adjustment that Fannie did to help people buy multi-units, you know, without putting a huge down payment. So I think this is a great piece right here.
Yeah, this is awesome. Only if we had multi-units in
But
Summerlin.
there's also a trick, right? Well, anywhere really, it's hard, right?
Yeah.
As soon as it comes up, I mean, they see the value in it. So, but if you could find one and qualify, then
cool.
I would say grab it, right?
Cool.
Especially 5% down to buy basically 4 investment properties.
Yeah,
right?
That's great. That's amazing.
And then you have them pay off your mortgage.
Yeah, 100%. Live in one. Yeah,
rent
that's the goal.
So, I mean, the 3 units hopefully may cover most or all of your
mortgage.
payments, so you're almost living for free.
Yeah.
You know, so that's
building
a
that
great
bank
program.
account. Yeah, awesome. Next, do's and don'ts. This is huge, right? So you see this all the time.
So this is something you should think about also before you think about even getting pre-qualified. But once lender says you are pre-approved, these are some of the things that you shouldn't do. You know, so one is, you know, I think a lot of times, you know, in the middle of transaction, someone gets into contract, and right in the middle of the, you know, between start and finish in the middle is a freaking holiday.
Right.
Right? Labor Day, there's those specials. Labor Day, buy fridge for, buy bed for $200. So okay, let me go charge that, you know, because I want to keep my money, but what that could happen was a lot of times we're going to re-update your credit to see if you acquired any new debt.
Once we go into contract, underline,
Yeah, so one is, no matter how that deal sounds great, one is consult with your lender if you could do that.
Yeah.
But recommend, if you don't have to, I would say don't
wait.
do it no matter what.
Yeah.
I believe in Murphy's Law. Even though lender said it shouldn't, but something weird happens, and
You don't want to chance it, especially you have EMD money back.
Yeah.
And if you go through that, you're gonna lose it. Yeah.
So what, and also don't charge up our credit cards, don't open new accounts, and also do not co-sign. And this is nothing that I see things happen all the time with family.
Yeah.
Of course you want to help your family.
Yeah.
Someone in your family doesn't have best credit, they need to get a car. It's like, can you help me? I need this car. I just need to co-sign. I'll pay. I'll make the payment. But at the end, then when you do that, they're gonna pull your credit, and also it's gonna also show up on your credit as a debt. So even though you're not making the payment, it could affect your qualification.
Income. Yeah.
So and then also don't quit your job in the middle. No matter what happens.
Yeah.
Don't quit your job.
Stick it out. Wait until the house closes before you quit your job.
Or your employer says, hey, goes like, what, we're restructuring and we're gonna move you from hourly or salaried employee, W-2 employee to 1099. It sounds great because they're not going to take taxes out. They're giving you the full pay. But the problem is that now you're basically almost like a self-employed, but you're 1099 and they're not taking taxes out. So now you have to wait 2 years of that income, because when you get 1099, you go to your tax person. Now they could write up expenses for you. So when you do that, we're going to look at what your bottom line is, not what you're actually making.
Okay.
Even though it's the same job. I mean, for instance, this was, I don't know, probably 8 years ago. Walmart drivers were W-2 employees, so they get paid hourly or salary, so they're fine. But Walmart decided, because it's cheaper for employers to pay people 1099, because they don't have to pay
the
employee tax and all that. So now this driver that's been working at Walmart for 10 years was about to buy a house, and now they changed 1099. So now it's like, now I've got to wait till we see 2 years of 1099, how you do your taxes.
Yeah.
Remember I said before, if you're W-2 hourly or salary, then you don't have to show
tax returns. But if you're 1099, you have to show tax returns.
Now we'll have to see how you did your taxes for the last 2 years.
Yeah.
So there's different things that could affect it. So it's just being with, I think a lender and agent that's there for you, that communicates, and service and out there for your best interest.
Yeah. So this one, I don't quite understand. Don't make any large deposits into any of your bank accounts. Why is that? How's that affect it?
So look, once a lender pre-approves you and you go looking for a house, typically I would say 70%, if there's an issue, it's with your money.
Yeah.
So when we ask you for bank statements, we ask for 2 months bank statements. One is to make sure there's enough balance to cover your down payment and closing costs. And if there's reserves needed, which means you have to have a certain amount of money left over in the bank or another account. But we also look at what's going into the account. So all the money has to be verified it's your money. So
Gotcha.
If your employer direct deposits your money, then there's
you
no
see
question.
it on that too. Yeah, you see it. Okay.
But if we've seen the last 2 months bank statements, if there's cash deposit of $1,000, we're gonna ask like, where did that money come from? You're like, well, it was in my safe, and we're pretty sure it wasn't in your safe, but we don't know it was in your safe.
And the underwriter's going to ask for like a letter of verification for that, because I've seen it. Maybe.
Yeah, sometimes depending on the loan, like FHA, if it's under 1% of the sale price, we could just do with the explanation. But depending on the money, other programs, basically the best you're gonna get out of it is there's that $1,000 that we really don't know where it's from. So if you have say $10,000 your balance and you need $10,000 to close, now the underwriter's like, we're gonna deduct that $1,000 because we don't know where that money came from. So now you're short $1,000.
Oh.
So what we're looking at is deposits, and as long as you could tell it's from employee or it's
been reoccurring. Yeah. So right. Yeah.
It depends if someone's someone has a tip job and maybe with something where they do consistent on a certain day, then we could explain my job part of this tip. So I save my money and I deposit a certain amount, or every Friday I deposit it. Then we could kind of work with that. But if it's just any random money you had, or you lent your friend $5,000 2 years ago and he paid you back, we can't use that money.
Okay.
Unless when you did lend in money, you actually
So you
made
had a
formal.
contract.
Yep, had it notarized and recorded it. Then now we know that you actually lent in the money.
Yeah, so if somebody's giving you money, it has to be notarized, recorded, pretty much. Okay.
Yeah, I mean, that's usually the biggest problem. Once you're pre-approved, sometimes it's verifying because one is your earnest money deposit. So say to get in contract, the seller wanted to give $2,000 earnest money deposit. One is we got to verify the earnest money was from your bank. So for instance, say you're out of town and you need to write a check and you couldn't do it, but your friend was in town. It's like, can you just write that check for me? Well, they're gonna see it's not from you, so they're not gonna count that money. So that's gonna get refunded back to that person, and you gotta
Come up with that
2,000.
money.
Yeah.
Yeah.
So they want to make sure where your money for your earnest money deposit is, and where your money for down payment. What they call it season money. So as long as you've had it prior to the 2 months bank statements. So right now we're in May, right? So 2 months bank statement is going to be March and April bank statement. So March 1st shows your starting balance of 50,000.
Yeah.
We don't ask you how you save that money.
Yeah.
We're just looking at everything else from
After
March
that.
1st
I got you.
to end of April.
Okay, cool. Continue to make your rent, mortgage payments, obviously.
Yeah.
Don't make any large purchases, cars, appliances, like you said. You see a sale, you don't want to do that.
If you have cash and it's going to affect your money to close, then yeah, if you're paying cash and you're not taking away from what you need for closing, then you could do that.
Yeah.
But do not charge.
Yeah, okay, do not charge. Notify us if you receive gift funds and closing costs. So that's the same thing we went over, kind of.
Gift funds. If you don't have all your money, you can have money that's
Gifted to you.
gifted to you. And the way it works is with FHA, what we need is we'll give you a gift letter, and the donor is going to put their information, their bank information, bank account number, and they just have to wire that money right into title at closing.
Okay.
And then we need their most recent month of bank statements to show that they've had that money in the
Yeah,
bank.
so they pretty much want to make sure it's not like illicit funds or something, right?
Right.
Yeah.
But conventional loan, we don't need the donor's bank statement. All we need is the gift letter that's signed by both parties with the bank information. And as long as that money goes from the donor's account straight to title at closing and doesn't touch the borrower's account, we don't need the bank statement from the donor. So
Okay.
there's one less step if you do conventional, a little bit easier.
Yeah.
So if you're dealing with gift, definitely let your lender know I'm getting gift, and depending on loan, he'll tell you how it needs to, work, so it won't be a problem.
Don't co-sign for a loan. We went over that. Stay current on existing credit and loan accounts. Pretty much went over everything. Anything else on the do's and don'ts?
No, I think those are all the big basic ones. But if other stuff come up, if you're questioning yourself, you're thinking about it, then just call the lender.
Yeah,
That's
100%.
all. You don't have to do, but that's why you're hiring us to help you with that stuff. So, we hope to kind of teach you the flow a little bit and what's required, because especially if it's your first home, this isn't going to be your last home. So one is, we hope we're giving you some education and help you kind of prepare for your next stage in home purchase.
Yeah.
Yeah.
So that was longer than I thought, but I mean, getting your finances in line is so important. That's why when Melissa called me, it was like, should I start now or should I wait till I'm ready to buy? Start as soon as you can, because getting your credit lined up will affect your interest rates, lower payments, all that stuff. And then when you're ready to buy, it's a smooth process. Yeah. So once I hand you over to Steve and he gives you that pre-qualification letter, what I do is, I get all your information, your criteria. What are you looking for a home? How many bedrooms, how many baths, what part of the town you want to be on, just all the criteria, what's your dream home. And then with you knowing your purchasing power, we know what we can look at. So we're not wasting our time looking at, stuff. And then when I send you these homes, I'll send you a broad range of them, even if the places you don't want to live at, just so you know the market trends and what's happening in the market. I do this to all my buyers, and they say, well, I don't want to live there. And I was like, I just don't want you to miss out on anything. We'll narrow it down as we go, and I find out what you like. And if you're from out of state, what I do for my buyers as well is I'll do thanks for staying with me.
No, I love this.
Yeah. What I do with my buyers from out of state is we'll narrow it down, and I'll do video walkthroughs with them, so they get a firsthand experience as if they were side next to me, because I'm honest in these walkthroughs. I'm like, it needs new flooring. It looks like this could be an issue. you're probably not going to like this. And the more I spend with my clients walking through homes together, the more I know what exactly they're looking for. So when they tell me if it's a long process, they don't find anything, they're like, oh, let's go look at this one. I already know they're not going to like it because we've seen one like it previously. I know, and I'll explain to them, you're not going to like it because of X, Y, and Z. Now, if I see one that I like, I'm going to be like, you probably should fly in and walk this right now because it's going to go fast. So that's the next step. And then, you know, after we find your house, we'll make an offer on it. We'll negotiate. You know, terms are important. We'll go over terms. You know, set time frame as far as terms go. Some people look at FHA, conventional, what you got down, how strong are you? And when we send that offer in, I always give my loan officers information so the listing agent can call and verify on how strong my buyers are. And if you're working with me from start to finish, you're going to be a strong buyer because we've coached you through every step. And then we'll get through negotiations. This is pretty quick what I'm walking through. So if you want to know more information about this, or I missed something, or if you have a question on something I missed, please reach out directly and I'd love to answer that question. But I'm going over the overall. So, so once we find a house, we negotiate the contract, we get in the contract. And this is where the real work for me begins, because looking for a house is easy, it's fun. I kind of like doing it. But negotiating with other listing agents and sellers can be a bit of a pitfall sometimes. And it could be, you know, there's some roadblocks. So once we go into contract, first thing I do is order an inspection. So if you're getting a loan, and we haven't even gone over VA loans because that's another thing. Yeah. You'll do another video just on VA loans for you VA people out there. But if you're VA, you got questions, reach out directly. So once we get in the contract, order inspection. I'm not going to go do a home without an inspection. Now, if you're a cash buyer and you want to waive the inspection, you know, that's fine. But if you're getting a loan, we need that inspection done, because on some loans, you know, if some things ain't right, like on the FHA, they have requirements for how livable the home is, right? So we'll get an inspection done. When that inspection report comes back, it'll tell me everything's wrong with it. There's always something wrong with the house. There's only been a few of really nice houses, and even then there's always little things wrong with it. And then we'll negotiate on whether we're going to have them fix it themselves, they're going to give us money to fix it, or a combination of those two things. Or they could say, no, we're not fixing it at all, you know. So inspection, negotiation, and then once we get that settled, what the loan officer will do is order an inspection. So as soon as we go into contract, he's...
Order the appraisal.
Yeah, sorry. Next thing we'll do is he'll order the appraisal. So when I send that offer over, his information's on it. I CC the lender on it too, just so he knows what's going on. That's why it's so important to, I appreciate when people use my referred lenders, because we work so closely together. So when I send that initial offer over, he CC'd on it, so he knows what's going on. So when that offer gets accepted, first thing he's going to do is order that appraisal. And the appraisal will run you anywhere from $300 to $600, depending on how big the house is, you know.
Yeah,
right?
I'd say mid-range is about, average about 500.
Yeah, okay.
On the appraisal.
Yeah.
And I was going to just kind of add a little tidbit.
Yeah, 100% VA.
So just give someone VA, it's zero down, so you don't need any money down.
Yeah.
And we're talking about mortgage insurance, there is no monthly mortgage insurance. So I just want to throw that in there for next time.
Yeah, 100%.
But we love helping veterans.
Yeah.
And we appreciate our veterans
100%.
service, and you know, we need to take care of the veterans, and that's a great loan.
Yeah.
So
zero down.
They have no idea they have this amazing program.
Yeah.
So we need to help our veterans, let them know they could buy a house with zero down. Because basically, if we finance 100%, you negotiate where the seller pays all the closing costs, and basically the veteran's buying a house with no money out of pocket.
Yeah, 100%. And
that's another one, but we just want to throw that in.
Where was I? Appraisal. So the appraisal is going to come back. And before we even make an offer on a home, I'm going to make sure to do a CMA, which is a comparable market analysis. And we make an offer that's going to be, because if you're a good agent, you're going to know where that values on that house when their appraisal come back. You're going to have an idea. Now I get it pretty close. So if we're getting a loan, I'm not going to put you in a situation where that appraisal comes back and we have to renegotiate the deal. Because I know some of you are searching for homes. You see homes that go under contract, then come back on the market. 90% of the time, that's the appraisal or the inspection, somewhere along between those two.
Those are two important things.
They're the most, I think, most important thing as far as the contract goes. So once we get that appraisal back, everything goes good. Then, you know, we just wait for closing. And then once we get the appraisal back from him, he sends it to the underwriter. And then this is when the underwriter might ask for some additional conditions. What are some conditions you usually see?
Conditions, they, you know, like we're talking about bank stamp, they may ask, you know, where was this deposit from? You know, I see this, what's this from? Sometimes if your year to date doesn't match with, if you're working 40 hours a week at a certain pay rate, you should have gotten this much by this, you know, this month. So one is they do look at what you've made, what you've averaged. So if you're full-time paid, doesn't match up to your, they're gonna ask like, what's going on with your income? You're a full-time employee, you get $30 an hour at 40 hours a week. Right now, by May, you should have made this much, but you're $5,000 short. So they'll ask like, why is your year-to-date short? You know, maybe you took a leave of absence or, you know, had to take time off without pay. So they'll ask when things don't add up. So, but, you know, at the end of the day, trust your lender and let your lender know everything.
Yeah, listen to them.
Because, you know, old days, you could maybe leave out something here and there and maybe it'll get missed. But at the end of the day, you could start it that way. But part of underwriting job is, they're like a detective.
Yeah.
They're going to look at everything. They do run some additional reports we don't have access to. So they're going to make sure everything is on there, is there, or something's not missing that the borrower didn't tell the lender about. So just, you know, it's a team effort. And our job is to get you into the house. And my job is to make sure everything's clean as possible so you don't have those weird questions that could possibly hurt you getting approved. So let the lender know everything and then let them figure out what needs to be there, what doesn't, and what, you know. So it just, bottom line, just be honest with
Yeah, be honest with your lender. So once you get through the appraisal part and the underwriting part, you're pretty much golden. They send out a clear to close, which is pretty much they'll send the funds whenever you go to escrow and sign the papers. And that's pretty much it. And then we go to closing, we sign, and once it records, like after you sign, I can't give you the keys. We have to wait till it records with county, which takes probably 3 to 4 hours. So if you get in the morning, it'll be done by 1 o'clock. And then I hand you the keys and you are officially a homeowner.
And that is when you can do whatever you want to do. When you get that key in your hand, you can go buy your appliance or charge it or change your job. But until you get that key,
don't do anything.
A lot of times, like, you know, a few days up there, you should be fine, but do not do anything. Once you get your keys, the loan's approved. We did it based on the day we approved the loan, what your situation is. We can't control what happens the day after.
Yeah.
So, but everything up until...
Yeah, so you can co-sign, you can go buy that new car, the boat, go get that furniture for the house and charge it all if you want, but not until you close on the house.
Get that key in your hand.
Yeah.
That means you are solid and it is your house and no one can take that away from you. Okay,
one thing we didn't go over is closing costs. So closing costs are typically anywhere from like 2 to 5% of your home, right?
Depending on the price. So I would say right now at our price range, you know, our average home price is like
$460. Yeah.
So I would say if you buy something for $465, I would say about 2 to 2.5.
2 or 2.5.
Lower price point, then I would say it's a little bit higher because what it is, some of the closing costs, some of the fees, like appraisal, isn't adjusted by the price of the home.
Yeah.
Whereas certain things like escrow fee, title fees,
buying your points down, if you want to buy your points down. PMI, and that's private mortgage insurance. So we just go over that real quick so people don't know PMI is.
So private mortgage insurance is basically when you don't put 20% down, that's part of your mortgage payment. You have your principal and interest payment, your monthly homeowner's insurance, your property tax, and your PMI. And that insurance isn't a benefit for you. It doesn't help you any. Basically, since you're not putting 20% down, the bank is insuring the loan in case you default on it. So that PMI kicks in if you walk away from the house and let the house foreclose and you owed, 400,000, but the bank was only able to sell for 350.
Yeah.
That's where the PMI, they covered the bank, and so they don't lose money on it. So it's not a benefit to you. There's no tax write-off for it.
You're just throwing money to the bank.
Yeah, because you don't have
Like
20%
insurance.
down. But I'd rather pay that than try to, depending how long it takes, save 20% down.
Yeah.
It still may be worth it, and down the road you could always refinance it. If you build equity, then you could always get rid of that PMI.
Yeah, and equity is going up around here like crazy, depending what part of town you're in. Homeowners insurance is about $700 to $1,500 annually. It's a hidden cost people don't usually tell you about. Something you're gonna have to. And this is included in that 1 to 5% of your closing costs. So this is all included. So you're going to see this on the final settlement statement, which I'll show you here in a minute from one of his deals. Then you always have utility deposit and setup fees. Sometimes you'll have to reimburse the previous owner or seller of the house for those fees. Of course, moving costs, home warranties. If you're buying a resale, that's super important because you never know, it might be an older home. And more times than I care to mention, after somebody moves in, the water tank goes out or the AC unit goes out. And if you don't have that homeowner's insurance, that AC unit's 10 grand.
Home warranty.
A home warranty, I'm sorry. If you don't have that home warranty, that AC unit goes out, that's 10 grand right there. But if you have that home warranty in place, it's like a $600 deductible and they replace it, which is great.
I mean, especially if it's your first time buying a home, I think it's usually you renew it every year.
Yeah.
And it's good to have it, little peace of mind. And it's your first home, so you don't know what to expect until it happens. So,
and it's only $500-600.
Yep.
Yeah. Property taxes here in Nevada are about 1%.
Yeah.
And that's pretty much all the hidden costs that you're going to see. But this is all included in pretty much your closing costs.
Correct.
Did we want to run a couple quick numbers real quick?
Yeah. Let me do one FHA.
Okay.
Okay. What price you want me to do this on FHA?
So FHA, let's do first time buyer, they're single, let's do a $300,000.
$300,000 with 3.5% down?
Yep. So this is why I had them here too, to run some numbers so you guys get an actual feel, because I know I'm spitting all this knowledge. But all you care about is the numbers. Tell me the numbers.
So let's do FHA 300,000, 300,000. And you put, it's 3.5% down payment is the minimum. So 3.5% down on a $300,000 loan on sale price is $10,500.
Okay.
Is your down payment. Let's use right now 7% for your interest rate. Okay, 7% for interest rate. So your principal and interest payment on the loan amount of $289,500, your principal and interest payment is $1,926. And then say around that price home, I would say maybe your insurance is going to cost you, say your homeowner's insurance is going to cost you $720
a year. Yeah.
So that's basically $60 a month. That's added on top as your monthly payment. Okay, so you have $1,927 your principal and interest, $60 a month for your homeowner's insurance, and say let's use 0.8%, kind of in the middle. Some houses are 1%, some are a little bit lower.
Yep.
It's just depending on when the house is assessed at what value. So if we do 0.8% of the sale price of $300,000, your monthly tax we're going to use is $200 a month. So right now you got $1,927, $60 for homeowners insurance, $200 for property tax, and then your mortgage insurance is at 0.55 for FHA, which is going to run you $132 a month for mortgage insurance. So if you throw all those in, so it's your principal and interest at $1,926, your homeowner's insurance estimate at $60 a month, your property tax at $200 a month, and mortgage insurance at $133. So your total monthly payment that you have to pay would be about $2,320 for a $300,000 $300,000 sale price
Yep.
with 3.5% down. So your down payment's $10,500, and I would say just
Closing
add
costs?
about 8.
8,000. So
So you need about
18,
about
18, 20
$18,000
for 300,000,
Yep.
$2,300 a month. But don't forget the HOA.
Yeah. So HOA is not going to be part of your mortgage payment, but it's a separate payment.
Yeah, but they factor that into
Qualifying. Yeah. So when a lender qualifies, a lot of times we're confused because like when they go to their max income, it's like you're qualified 300,000, and then you find a different house with HOA. Now I tell you you only qualify for 250, because when I qualified you, I didn't have
that
HOA in
HOA
there.
in,
So it's not qualifying on the principal and interest payment of 1926. It's principal and interest, tax, insurance, and if there's HOA, it's basically you have to qualify on your monthly housing expense.
Yeah.
Which is all that added in. So right now it's not qualifying at 1927. You're going to qualify at 2320. So depending on the house, even though it could be the same sale price, taxes may be a little bit different on the house.
Yeah.
Somewhere else you may have HOA, so it may make a difference on payments. So it's not, if you qualify 300, no matter what everything is, you could still qualify.
Yeah.
If you're qualifying under, if you're being conservative and you're way below what your max is, then yeah, your payment's gonna be hard, but maybe you're still qualified.
Yeah.
But if you're going to the max limit, then yeah, we got to look at every little thing.
Yeah.
To make sure we keep your bottom line overall housing expense the same number.
Yeah. 100%. And then those numbers might discourage you, some of those, because you're probably looking at $300,000 houses right now, and you want to live in that house with the picket fence and the swimming pool and all that stuff. And I have to stress this so much for first-time home buyers. You might have to sacrifice a little bit for a short time, 2-3 years, and get your foot in the door becoming a homeowner, because that's forced savings, you get equity. So that's building your nest egg for that picket fence. And a lot of these first-time home buyers, I've had a few of them that wouldn't accept anything for less, and they'll probably be renters forever, unfortunately. So your first house, unless you got a really good job and make a lot of money, is not going to be your dream home. But getting that foot in the door, building that equity, it's so important. It's steps. There's levels to this.
And one thing I'm hearing right now is, sometimes the mortgage payment is going to be more than the rental payment.
Yeah.
So that people are like, well, why am I going to do that? But like you were saying, you're building equity. I mean, even though maybe your payment's high right now, right now the payment's 2320, right? Say 2-3 years from now, interest rate drops to 5%. Okay, so now you could refinance and get a rate at 5%. The principal and interest was 1927. So if your rate ends up being 5%, then it goes from 1927.
It's pretty dramatic, I think, too.
Yeah, so
15 something.
if you refinance and say you have the same balance, which you're gonna have low balance anyway, you're going from 1927 to 1554. By dropping 2% in interest rate, you're almost dropping almost $200. So,
yeah, 100%.
No, more than that. Did it say it was 1927?
Yeah.
Right? You're like almost
$400. Yeah.
So,
and that's huge.
So right now, the other phrase that we use in our business is
marry the house, date the rate. Yeah, 100%. Because when those interest rates do come down, prices are going to come up with supply and demand, which we saw in 2021, 20, and the very beginning of 2022.
Yeah.
People are paying 50, 100 grand over because the interest rates are so low. Yeah. So either way you look at it, you're going to end up spending that money. So
So even though renting may be cheaper, if you're looking at long term, you're going to end up paying this house down or paying it off.
Yeah.
So what's better than having a mortgage paid to zero than you saved 100 or 2 by renting, and you got to keep paying that.
What is the average HELOC interest rate?
Interest rate right now. So interest rate, your typical interest rate is it's your prime rate plus the margin that the bank gives you when you get the HELOC. So basically, prime rate is at 8.5. So HELOC, when in 2020, when the pandemic happened, prime rate went to 0.
Yeah.
So it was really cheap. So for 2-3 years, it's like, prime rate's low, get a HELOC, it's cheap. But now it's high. It's 8.5 plus your margin. So if you have good credit, the bank may only give you like say 0.5% margin. So 8.5 plus half, so you're paying 9.
Okay.
But sometimes you may get a 2% margin. That means whatever the prime rate is that month, plus your margin. So now
2%.
you're at 10.5 on that payment. So
That's crazy. I was gonna say there's a HELOC hack, but it does HELOC.
and right now, I think that HELOC works is if you have that great
Equity.
rate, that 3%, 2.5% interest rate, you don't want to redo that. But if you want to pull money out, there's only two ways. You redo the whole loan
Or just
and
do a
pay the
HELOC.
current rate and lose that low interest rate, or get a HELOC, keep that low rate, and use that HELOC, and then you could always, like we said with the second, you
Pay it off.
Pay it off,
Yeah,
you know.
yeah.
So right now, even though it's expensive, but like every month when they calculate it, it's based on the prime rate that day. So if it starts going back down,
Yeah.
you know, if it goes down to 6 or 5, then it'll be cheaper. So, you know, it's a moving target. It's like a credit card bill. You know, every month they're gonna do your payment based on your balance and what the rate is on that day, and that's your payment for that month. So it's almost like a credit card against your house. So you could pay. So say you got approved for a $50,000 HELOC. You don't have to use it. You could keep it for a rainy day or when you need it. So say you charge it up to $40,000, and then you end up paying it off. So now you still have that money access. Usually the typical HELOC, they give you the first 10 year where you could draw from it. So you could use it like a credit card.
Yeah.
Pay down, charge, pay down, charge. So it's a good tool to have. And if you don't want to use it, then you just keep a zero balance. So 8.5 for zero balance is still not a bad rate.
Yeah.
You know, so it's just kind of understanding how it works.
Cool. Well, I think that's it. I'm pretty sure we missed a lot of things. There's so many nuances that go into buying a home. If you have any questions, please reach out to me. If you have loan questions, Steve's information will be in the contact information below. Steve's information will be in the details below. I thank you guys for watching. This was a super long video. I hope my editor cuts it. But
We'd love to help you and answer questions for you.
Yeah, 100%.
We're in your corner.
Yeah. Got anything else for the camera? That's pretty good.
Yeah, it's pretty good.
Thanks for coming and doing this. I appreciate that. So as always, people, thank you so much for watching. Stay curious and keep exploring, and I'll see you guys on the next one.